Hi, everyone. This is Jason Bjark of Wall Street from E Street. Welcome back for another Wall Street from E Street podcast interview. Today's special guest is a returning guest and one of my favorite guests. He's editor and publisher of the Gloom, Boom, and Doom Report, Dr. Marc Faber. Thank you for joining me again.
It's my pleasure, Jason, and good day to all your listeners and viewers.
And you're in Thailand, right?
I'm in Chiang Mai in the north of Thailand, correct?
So we're recording this interview on Thursday, August 8th, 2024. Mark, the 10-year US Treasury yield, it's been bouncing around a lot. It got way below 4% on the yield. Do you think that this drop in the 10-year US Treasury yield, the drop in yields, is this a flight to safety?
I think that gradually investors realize that actually the economy is much weaker than the statistics that are published by the US government, who is an institution that specializes in lying and deceiving the public, publishes. So in other words, the economy has weakened considerably, but the economic statistics that are published by the government still show some moderate growth. But the reality worldwide is that the economies, after a strong rebound coming out of the COVID incident in 2020-21, they had a recovery phase because of the huge stimulus in 22-23. And now, 24, we are lower than in 23.
So in the last 14 days, the yields in the 10 years Treasury have dropped a lot. Also, we've seen some very unusual activity from Warren Buffett. He normally doesn't dump shares this fast, but he's been selling Bank of America shares the last 14 days like there's no tomorrow and buying US Treasuries. Do you think that he's worried that the banking system is in peril?
Sorry, I'm not a mind reader. I don't know what he thinks. But as you pointed out, it's unusual that he would be so cashed up as he's now. It doesn't mean that the stock market will collapse, but like we see that, say, an investor who has $100 million or $1 million or $1 billion, if he can lock in his money at 4 to 5% on deposits, it's probably a reasonably good deal because stocks are not inexpensive and they're likely to go down over the next 12 months. So in my view, he's taken a bearish view about the market, that undoubtedly, as I have. And I've written now 2 reports that I believe that we are at major turning points in asset markets, not just stocks, but other assets as well, that real estate will go down, that everything will go down. This is my view.
So you don't think that the Fed rate cuts can save commercial real estate and residential real estate?
I think you must be joking that rate cuts will save US commercial space. There's so much of it that rate cuts won't help much. Now, as you know, commercial properties are down in many cases close to 70%, and the real estate is valued at next to nothing. I don't think they will go much lower, but to anticipate a strong recovery would be wrong. Equally, if we've seen the commercial space drop across the board by, say, 50% or more, I think residential properties are the next one to turn down.
Yeah, I agree on your views on commercial real estate. I was actually just going to ask your opinion of the rates. I think it's a cash flow problem, Mark, because I think in the major cities, metro areas, these office buildings, whether it's like Pittsburgh or many other cities or metro areas, I mean, it's at least 30% empty, these office buildings. Some places is 50% empty. So that's lack of cash flow to service debt.
Correct. The problem is, and I maintain that, or that was my view throughout my life, you shouldn't use too much leverage. But in the American culture, it was built in that you borrowed money, credit card, other household debts, mortgage debts. The government borrows money because they don't collect enough tax. Although taxes are very high, they still feel that they have to spend more than they collect, so there are deficits. These deficits lead to a growing debt burden, government debt, and when interest rates no longer decline, this government debt becomes a burden. It is a tax on the system that every investor must realize. It's a tax because the government doesn't collect it, it collects it through inflation. I think the outlook is very, as far as I'm concerned, the economic outlook is extremely negative. But the government can print money. And Trump has just said that the president of the US should have more say in monetary affairs. It means he wants to borrow even more money than has been borrowed. This will lead to growing government debt and eventually higher interest rates, higher inflation rates, and the collapse of the US dollar.
For your points on real estate, I mean, I know a lot of real estate investors here in the US, and very, very few of them use all cash. Almost all of them, real estate investors and also real estate developers, they all use debt. They love debt. And then it seems that like every cycle, the banks just want to give them more debt after bankruptcy and bailouts, that the banks are like, okay, the cycle reset, real estate prices will start going back up. We're going to start giving the real estate developers even more debt again.
The usage of debt has been encouraged by the government. Not under Mr. Trump, but previous governments encouraged the leveraging up of assets because the interest could frequently be deducted.
Oh, yeah. You've been through commercial real estate cycles in New York City with all the famous developers like Samuel Adelson, Sam Zell, Donald Trump, Steve Wynn, many of the other guys. I mean, most of those guys went bankrupt at least once or twice in past cycles.
Yes, especially Trump. He's the specialist.
Well, he survives the bankruptcies and then he figures out how to get more investors. Anyways, though, I want to ask you about past Fed rate hiking cycles. Did they normally break banks outside the US when the dollar gets too strong and when the Fed keeps interest rates high or starts raising rates? Does this normally happen in past cycles?
Every cycle is different. There are cycles when monetary tightening led to bankruptcies. Like in the 70s, Bank Herstatt in Germany went bust. But it didn't have an international repercussion. And in other cycles, it didn't matter. So each cycle has to be looked upon specifically. My view is that up to now, the US has increased interest rates, but it has not tightened monetary conditions, because had the US tightened monetary conditions, the stock market would not have been making new highs. You understand? There's a big difference. You could have 100% interest rates like we had in Argentina and Turkey, and money wasn't tight. You could have 3% interest rates and money is very tight. The absolute level of interest doesn't tell you whether monetary conditions are tight or easy.
Well, they also added the liquidity programs like BTFP, right? When Silicon Valley Bank, because that normally would have crippled the banks and there would have been more bank failures, but then the Fed put the emergency liquidity programs in.
Correct.
And they're not counting that on their balance sheet, right?
Look, the central bank controls essentially the quantity of money. And there are many ways in which the central bank can play tricks. They can increase interest rates, but at the same time provide liquidity. This is what has happened in the last 2-3 years.
Do you think the amount of dollar denominated debt, like outside the US, like in the Eurodollar system, other countries, foreign governments, foreign corporations, they borrow more dollars when the dollar is weak? Do you think that that's put more strain on the system than when the Fed does start to raise interest rates again? Because that would make it different than past cycles, like you just described. Whereas, like this, I'll give you an example, like that Japanese bank, right? They have a lot of US Treasury exposure. They probably have a lot of dollar denominated debt. They've been playing around in commercial real estate. Do you think that the banking system is more fragile with all that dollar denominated debt when they're in another country?
Well, this is a very good question. In general, I would argue that the banking system, the financial system, is highly unstable and more unstable than it has ever been in the history of capitalism. And let me explain to you why. If we go back to, say, the 1950s, we have a very strong economy in the US that was growing very rapidly. And the economy, or the economic activity in real terms, was a multiple of the financial market, the stock market and the bond market. From the 70s onwards, the financial market has exploded in terms of size compared to the real economy, which, if properly measured after 1980, didn't grow much. But in any event, now we have, say, a global economy that has the size of a pack of cigarettes, and we have a financial market that has the size of a helmet of a motorcyclist or a car racing driver. A multiple of the real economy, where transactions, trade, and so forth, manufacturing occurs, is the financial market. And in my view, this huge financial bubble, this asset bubble, will have to be deflated. And I think we've reached a point where the beginning of this deflation in assets will occur.
Does it look like we're getting a lot of large margin calls now from like hedge funds and these portfolio managers at banks on these over leveraged trades like the yen carry trade and the leverage short volatility trade?
For sure, there were some margin calls because when an asset goes down, like Japan the other day, people have to meet margin calls, then they have to sell other assets. That's why I want to caution investor about the following. In a bull market, not every stock goes up, and in a bear market, not every stock goes down to the same extent. But say in a bull market, in a healthy bull market, 80% of stocks go up, and in a healthy bear market, 80% of stocks go down. Now that we had bull markets in all assets, in collectibles, in bonds, stocks, commodities, real estate, paintings and wines and all sorts of watches and so forth, once something goes down, it may trigger selling in another asset. And so I believe that we have reached a point where from here on, all assets will go down in value.
Yeah, things seem extremely fragile right now, and it looks like the margin calls are starting to feed on themselves with all these different over leveraged trades. I think there was a Bloomberg article back in April about the too big to fail hedge fund. I'm just scratching my head because you were on Wall Street during long-term capital management, and it seems like no one has learned any lessons.
This was the problem of long-term capital, LTCM. In 1998, when they went bust, the Treasury and the Fed bailed them out. And that was a huge mistake because it gave a signal to Wall Street, leverage up. And this led then in 2006, 2007 to the housing crisis, which culminated with the great financial crisis. And after that, you would have thought that the institutions would have learned something. No, the debt grew even more, but this time, not so much in the private sector, but in the government sector. And I tell you, the governments in the Western world, they have some choices. Either they have to increase taxation. Nobody will get elected if he goes to the people and say, look, we live beyond our means, we need to increase taxation. Nobody will be elected. The other way is a possibility, especially under Trump, is to negate on debts. To negate on debts and non-payments of debts by government is an extremely messy condition. Because the pension funds, domestic and foreign, they all own government bonds, and the insurance industry and so forth. So this is very messy. Then the third way is to print money. And every government from the times of Babylon, 5,000 years ago or more, has been printing money when it became problematic with the government's finances. And I guarantee you, it doesn't matter whether Harris becomes president or Trump. The US has no other option but to print money. And that's why we will get more inflation, and some assets will go up that are relatively immune, assets that cannot be multiplied much, such as precious metals and bitcoins and so forth. These assets will go up, and the standards of living of the ordinary people will go down. Because, look, you look at me, you said before that some people benefit from inflation and so forth. Yes, I benefit from higher interest rates because I have cash. So now I get 5%, 4%, whereas 2-3 years ago I got 0% on my deposits. But having said that, I think it would be dangerous for someone to say deposits or treasury bills at 4 or 5% is safe. No, it's not safe. Nothing is safe. We have now governments that are without any hesitations, without any remorse. They can do whatever they want. The government no longer represents the people. They represent themselves. They're all tyrannical. They're all despotic. And the investment environment in this condition is extremely difficult because the government have, all of them, Trump, Harris, and especially this new fellow, Walz, they're all extreme interventionists. They don't want a free market. They don't want free competition. They want to rule the world.
And you've talked about the quantitative easing programs after the 2008 financial crisis, how you thought that they were coordinated by the G7 central banks like the Federal Reserve Bank and the European Central Bank. Do you think now that the larger G7 central banks, they realize that there's a problem that the Fed kept interest rates too high and it's breaking the fragility of the banking system outside the US, and now there's going to be coordinated rate cuts by the other central banks going forward, like the Bank of England, the European Central Bank, and then the Federal Reserve last, maybe?
Yes, I think that central banks, on the slightest sign that the recession is more serious than what they assumed, that all of them will cut rates. And that as a result of that, we'll have more inflation. I mean, now they talk about that prices no longer go up. This is utter nonsense. Prices go up everywhere. Now, it is true that some businesses are, let's say, not increasing prices as much as before, because by increasing prices, the affordability of consumption has diminished. In other words, before I have a salary of 100, okay? Now I may have a salary of 120, but the cost of living is up to 130, 140. So in real terms, real inflation adjusted, I am less prosperous than 5 years ago, 4 years ago.
Yeah, I think that's a very
the reality is simply, nobody can deny that more than 70% of people in Western Europe and the US, they are worse off than 4 years ago. It's statistically proven. The central banks have these statistics. Now, is Warren Buffett wealthier than 5 years ago, or Jeff Bezos and Elon Musk and Marc Faber? Yes, because the financial markets went up, but ordinary people don't have much participation in the financial market because they have no money. It's statistically shown that close to 70% of Americans live paycheck to paycheck. They have to wait for the paycheck to pay their bills. How many stocks do you think these people own? Nothing. They are the ones that get hurt from inflation. But the rich people benefit from inflation. That's why we have it in the first place.
Yeah, it's the Cantelon Effect. So it's a form of corruption with the artificial currency and credit. And then the Fed, what it was openly stated Fed policy since the Alan Greenspan Fed. And then Bernanke carried it on. And then Janet Yellen carried it on to try to inflate the stock market and home prices so the consumer here in the US would spend more.
I'm very happy, Jason, that you spelled it out. It is a form of corruption. Correct. That's what it is.
Yeah, I think the definition, the Cantelon Effect, a lot of people don't, first and foremost on the definition, don't say that it's a form of corruption, but it's happened throughout history. The real economy, Mark, it's bifurcated. One of the things that people don't understand, you brought this up, is an important point, is accumulated inflation. So the consumer price index, everyone's talking about, oh, the inflation rate in Europe is 1%. Here in the US is headed below 3%. But if the real inflation rate is 2 or 3%, I mean, over every year, and it's compounded over many, many years, I mean, people's standard of livings will be cut in half over 20 or 30 years very, very quickly, even at a low inflation rate.
Correct. And there's another point I want to stress. Let's say the price level, this we don't need to discuss about. This is the reality. The price level, say, in 2019, before COVID, is 100. Now it is, say, 120, 125, and 130. Who knows? We're not going to argue about this, but it is meaningfully higher. Now, at some point when you have these price explosions, prices for a while will stabilize and no longer go up, and some prices actually come down. But to say that inflation has been solved is not correct, because the price level, even if today, months on months, price increases are only less than 2% annualized, the fact is that the price level is still 20% higher than, say, 3-4 years ago, or 30%. I know statisticians who are very good. They analyze the figures very carefully. In their view, inflation is much, much higher than what the government is publishing. Also my observation, by the way.
Oh yeah, look at the insurance premiums. There's stuff that the consumer price index, it doesn't accurately measure people's healthcare insurance bills or what they're paying for insurance. It doesn't measure any of these things that the average consumer or small business owner pays on a day-to-day basis.
Correct, correct.
So then you don't think then that the system, Mark, would you say, is it fair to say that the system after 2008, they changed all the rules, the belts, all that stuff, that it basically morphed into a Ponzi scheme where they have to use bailouts and they have to keep growing credit or the system could collapse with deflation and bankruptcy?
Well, I studied economics at the time when classical economics were taught, and mostly the original classical economists are French and Austrians, because Austria was a huge military and geopolitical power. And so most economists were in Germany. They called them the Austrians and so forth. Yes, it's sort of a Ponzi scheme, but it can last for quite some time. I just want to point out, I wrote reports in 2020 about Turkey. And as you know, in Turkey, we have very high inflations of around 100% per annum, and interest rates are also thereabouts and so forth. And stocks were in 2021, at the end of 21, very, very inexpensive. So I recommended Turkish stocks. Then many readers of mine, they said, you're crazy, this is a disaster, it's hyperinflation, and I understand all this. But stocks were cheap. And inflation accelerated out thereafter, and stocks went ballistic. But in the case of the US at the present time, stocks are not cheap. They're not inexpensive. Equally in Europe, stocks are not inexpensive. So I would be very careful with buying into, I have a large stock portfolio, but it is about 25% of my assets. The other assets are in real estate here in Asia and in cash and bonds and in precious metals, physical, and some stocks, but I prefer physical precious metals.
So for risk and reward, you don't see a lot of good value for distressed assets right now?
Well, we have to define what is a distressed asset. I think Latin American assets are not very expensive, but I think they may go lower. I think what is really strikingly cheap, inexpensive, are gold shares and mining stocks around the world, especially in South Africa. They're very inexpensive. And two, real estate developers in Hong Kong. Their companies are not leveraged or leveraged to a very small extent. And they sell at about 30% of net asset value. Now, the net asset value, we have to write down, but I don't think we need to write it down by 70%. So, because in Asia, the office is a bit different than in Europe and in the US.
Now,
But that is a cheap asset class.
So those are those real estate investment trusts in Hong Kong?
Most of them are listed in Singapore. I own most of them. They haven't done well. But it's important to realize as an investor that the dividend yield is a very important component of your total return. So if you look at the performance, say, of the Dow Jones in the 1970s, the Dow peaked out in 64 the first time, second time 66, and by 1982, it was lower than in 64 and 66. But if you held the Dow Jones all this period and you continuously reinvested the dividends into the Dow, you still made a lot of money.
Now, you also brought up South African miners. I mean, the platinum and palladium miners in South Africa, I think they're producing the metal below production cost. And so, like, these investment banks are predicting that there's going to be shortages of platinum and palladium in the next couple of years. And a lot of people think that electric vehicles, that the demand for platinum and palladium from like hybrid cars or regular cars for catalytic converters will collapse. But it looks like they're going to end up being wrong because a lot of these electric vehicle makers, Mark, it's wasted funds and they're close to bankruptcy.
That is also my impression. I think this whole hype about electric cars will end in tears and huge write-offs. I mean, it doesn't make any sense to have an electric car where you plug in the electricity that is produced by coal mines and oil and other fuels. You understand? And the batteries are about the worst for the environment that could be ever invented, aside from these ludicrous windmills. You know, you have to go back to the 15th century to build a windmill. This is a complete madness of the Greens, who actually are not concerned about the environment, but about socialism and communism. That's what they are. They are politicians who want to suck the system dry for their benefit, not for you and me.
Yeah, I agree. It's a waste of funds, misallocation of capital. The government is very bad at allocating in energy. I call the ESG investing for green energy, I call it the energy spending grift.
Correct.
But like the socialists you said, I mean, there was a book about it and it got bashed, but it was called like 10 years ago, it's called Watermelon. So it was saying that people are green on the outside and red on the inside.
Precisely.
You know what else looks cheap, Mark, is U.S. natural gas. I mean, that's what. Let me pull it up here. It's barely above two right now.
I agree with you. I mean, oil and gas the stocks are inexpensive relative to everything else. But the dilemma I have is, I can say this is cheap vis-a-vis Nvidia and the Magnificent Seven. Everything is cheap. The question is it absolutely cheap if interest rates will be at 10% in 4 years' time?
Oh, so you think rates will actually go? Will rates go that high for the government or just for the private sector?
I think rates will go higher, period. Interest rates cycles, inflation cycles last, say, 25 years to 50 years, so thereabouts, roughly. We've been in a declining interest rate cycle since 1981. In other words, more than 40 years, until 2020. We are now in an interest rate cycle that is going up. And in my view, it will go up for the next 20 years or so.
Okay, so basically then for the private sector, it's going to be very tough for these small cap companies to use debt for any type of growth then. They're going to have either some type of partner, like a larger company, or they're going to have to sell their projects out, which we've been seeing in the liquefied natural gas exporting space, because those projects are very, very expensive. And a lot of those companies, the small caps, plan to use debt.
Yeah, you're right. I have to laugh because the one who's going to suffer the most if interest rates go up as much as I say, and Dudley, he was a former president of the New York Fed, he said it the right way. If interest rates keep on going up, the governments will have a huge problem, because they have to then issue more and more debts to pay the interest on the debts. So this will become very problematic and messy. And that's why I say I would be very cautious about buying the dips here. I think it may be prudent to raise some liquidity for investors. I don't need to raise a lot of liquidity because I only have 25% in stocks. But you understand, if stocks go down, I believe that gold will also get hit, whereby it will go down less than stocks, but it will get hit. Also, dollar will get hit, and real estate will get hit. Everything will get hit. But I'd like to explain something that, in my view, is very important for an investor to understand. An investor on day one, he has $1 million. And the asset inflation, due to the money printing by the government and fiscal deficits and so forth, is, say, 50% over 5 years, okay? So all assets go up by 50%, some more than others, but in general, overall price level goes up 50%. And you and I, we are prudent, and our assets only go up by 20%. Not bad in 5 years' time, but we're losing out vis-a-vis the majority of people whose assets go up by 50%. Now, let's turn this equation around. The markets drop overall by 50%, the asset markets, because of tightening monetary conditions and disappointing corporate earnings or whatnot, or war or whatever. And our assets only drop 20%. So overall, the asset prices drop 50%, but you, Jason, and I, Mark, our assets only drop 20%. We should be in sevens heaven because we are relatively richer than the majority of people. You understand? In a bear market, everybody loses, but some people lose much less than others.
So it sounds like defensive and liquidity for a lot of people, because a lot of people are getting margin calls right now. And I think that's why you're seeing selling in like NVIDIA.
The problem with liquidity is that banks can fail. They've done that repeatedly, and you and I, with our deposits, may lose all our deposits. All. Happened in Cyprus, happened in Brazil before, nothing new.
Okay, last question, Mark. Do you expect non-G7 governments and central banks, including like the PBOC, People's Bank of China, and others, to continue to dollar cost average gold tonnage, maybe each month or every couple months going forward, based on like the spending in DC and the Russia sanctions?
I think any central bank that doesn't belong to the American colonial imperialism, such as Europe, New Zealand, Australia, Great Britain, Canada, all the other countries, 88% of the world's population will not trust the US government anymore. The prestige of the US has diminished everywhere in the world. And the Russians and the Chinese and the Iranians and the Syrians and the Africans and the Latin Americans, they don't trust the government anymore. And they will have more and more of their reserves, not in US dollars, but most likely in gold and gold similar reserves, maybe silver, maybe platinum, maybe bitcoins and so forth, but nobody will trust the US dollar anymore.
Well, I mean,
it may be wrong. The dollar may continue to be strong because the interest rates in America, like I have a choice. I can have euros or I can have Asian currencies. But my view is the US dollar is grossly overvalued against Asian currencies. No question about this. Also against the yen. But the yield is so much higher in dollars that many people still hold dollars because they get 4 or 5% on deposits. In other currencies, they get 1 or 2%.
Demand for U.S. Treasuries from retail investors outside the United States seems to be strong, but it's the China, like their central bank and Bank of Japan, that are large net sellers of Treasuries recently. So it seems that like the usual buyers of Treasuries the last couple of decades are not net buyers anymore.
This is probably true. Yes, that would be my view. But the question that you asked was essentially, will foreign central banks continue to buy gold and precious metals? And I would answer this in a positive way, whereby I have to point out the following. When the economy turns down significantly, the typical household that is not rich, they own, say, a house with leverage. They own a car and maybe motorcycles or 2 or 3 cars, and they have insurances and so forth. The most likely asset that they can sell and the neighbors don't see it. In other words, the man who owns a house and lives in a neighborhood and has children and goes to school and drives a car, he doesn't want to lose the car, but he can easily sell gold. So in economic harsh time, the easiest for many households to do is to sell gold. So the price has gone up, but as the price went up, lots of people sell it, don't buy it. They sell it because that's the only thing where they can raise liquidity. They have the house they can sell, but at a loss. The car they can sell, but then they lose prestige because they can't drive the children anymore to school in a car. You understand? So the first thing that ordinary people sell when prices go up is gold.
That's actually exactly what has happened, Mark, the last 10 months. U.S. retail investors did not buy a lot of physical gold and silver. They were actually very, very large net sellers. The bullion dealer that's publicly traded, the wholesaler A-Mark, has said that their sales are down enormously, and there's a lot of articles that Americans were cashing in. So all the demand for physical gold the last like 9-10 months, the big demand spike has been out of like China, India, Japan, Korea, Thailand, Vietnam, the retail investors there, and then central bank demand.
Yes, correct. I've been talking to people to buy and own gold for the last 40 years. So it's not that I'm suggesting to buy gold tomorrow because I think it will go up. But I have no faith at all in governments. I think they're dishonest. I think they're incompetent because they're run by professional politicians, people who have never worked a single day in their lives in the private sector. That I want to point out. A lot of politicians today and bureaucrats, they went to a useless university where the professors are all socialists or mostly socialists, and then they go and join the government with a degree in political sciences or whatnot, but they never worked. And I think a precondition for any in government should be that they have a few years' experience in working in the private sector. None of them has ever run an own business. I mean, I'm very critical of Trump. I think it's sad for a country to have people who are as uneducated as Trump to become president. But at least he works in the private sector.
Yeah, I mean, here in I live right outside of Washington, D.C. for almost 25 years. And like, there are a lot of people here who do have businesses, but they're all like connected to a political grift. So they're all like a lobbying firm or a consulting firm that they use through their government connections. And that's how they're making 6 or 7 figures a year. It's not through producing a private sector good or service that benefits the economy. It's through some type of, I would call it rent seeking for the economic term.
You're very polite. I think all these lobbyists are high-class whores.
Well, they use high-class whores, but that's another. Oh, I'm gonna get in trouble for that joke.
Okay, Jason. Nice talking to you.
I want to thank you so much for your time today, Mark. If my listeners want to check out the Gloom, Boom, and Doom report, how do they do so?
Well, I have a website, gloomboomdoom.com. I repeat, gloom, boom, doom, all in one word.com, or they can Google my name.
And I want to thank you so much for your time today. I always enjoy our discussions.
Yes, Jason, take care.